Hi everyone, thanks for watching. I'm going to give a quick overview of how to trade the yield curve with CME Treasury Futures contracts. So first of all, on this top screen, I have the 30 minus 5-year spread. So basically, it shows the steepness, the slope, not the shape, from the 5 to the 30 year. And let's say we want to speculate with yield curve contracts, CME Treasury Futures, on the slope of the curve. So in the bottom, we have our ZF and we have our ultra bond. For instance, because price is inverted with rates, if we were to buy the ZF and sell with the ratio the ultra bond, we would actually be positioning for a steepener. If we were to sell the ZF and buy the ultra bond with the correct ratio, we'd be positioning ourselves for a flattener. Now, what's interesting about this is it's all about getting the ratios right. Whenever you have the correct DV01 ratios, you'll actually see that you're not trading are rates going up or down. You're trading how does one rate trade relative to another. Now, this example is just going to be for a spot one time. As rates change, the DV01 changes because of convexity mismatches, but I'll get to that in later projects. But for now, if you're a retail trader or you want a quick thesis on the yield curve, this will be accurate. Now, if you're an institution doing fixed income relative value on leverage, that's when things can get messier. So the first thing you're going to need is you're going to need either an institutional or a proprietary ratio calculator. Now, this isn't actually indicative of the market cheapest to delivers. I'm just giving this as an example. So let's just say the CTD clean price on ZF is 100, its mod is 7.8, and its CF is 0.8125. The ultra bond is 10225. Mod here, this is really inaccurate because I had data. Let's put the mod at about 2397 and CF at 0.9012. So what you'll see here is we input, it doesn't matter if the longer or shorter durations first, the calculator will still work, but the calculator gives cleaner numbers if you put shorter duration here. You input the data here. Let me just make this more accurate with like a 3.7 mod. And this shows you your DV01 on each of those futures contracts. So in this hypothetical example, your DV01 or profit and loss for 1 basis point change in the rates is 45 for the 5-year and 271 for the 30-year. So that that aligns with just the logic further out in time, longer duration, more exposure to rates. And let's say we wanted to do 1,000 contracts. So let's say we wanted to, in this example, let's trade a steepener. So let's long the 5-year and let's short the long 30-year. So if we longed 1,000 contracts of ZF, and this is the cheapest to deliver duration, modified duration data, and same for the ultra bond. For those 1,000 contracts of the 5-year, we would only need about 167 and a half ultra bonds or 30 years, and that just really goes to show a retail mistake. And I've made this mistake before looking at fixed income relative value, is to see, let's look at this. Oh, I want to trade the shape of the slope of the curve. Well, it's easy. Buy one, sell the other. And that's inaccurate. And just as you see with equities, whenever you trade perfect hedges, you're looking at beta, you're looking at splits in the share prices. And if you don't get, for instance, if you want to trade SPY QQQ, if you don't get that ratio right, you're going to end up having a weird hedged exposure in one index or the other. And to make this clean, you need to make sure, if in our example we were doing a trade, if I wanted to long 1,000 for a steepener of this, so I would be buying these, I would have to, let's get our ratio here, let's do 168. The more contracts you do, the cleaner the math is. So if I were to buy 1,000 of these for the almost perfect DV01 hedge, we would only need 168 of those. So that goes to emphasize that we can either sell, buy, sell to get our hedges right, but this isn't simply a trade where you just buy one contract to sell the other. The math gets complicated. In my GitHub, I actually show for the hedge ratios between the futures and the CTD. That can change, but you'll also see if this was at about 13 and a half basis points here, and you can see it declines, the ratio declines. As the ratio moves, this perfect DV01 changes. So for every 1,000, if rates change, you might have to do 170, you might have to do 165. So unless you keep up with this in real time, you can start to see yourself getting short or long rate exposure you weren't really wanting simply because those ratios drift. Anyways, I hope this helps you guys out. If you want to use some of the retail available tools, some of the student tools I have, it's linked in my GitHub on my bio. And anyways, I hope the best for your fixed income relative value trading or your fixed income education journey. Have a great rest of y'all's day.